Do you know what happened on a single day in 1929 that shocked the entire world and triggered the worst economic crisis in history? I'm not talking about a war or a natural disaster. I am talking about the Wall Street crash, an event that forever changed how we see money, finance, and the economy. And the craziest part, the lessons from that day are still incredibly relevant today. Stick with me, because what you're about to discover could completely change your approach to money forever. To understand what happened, we have to go back to the Roaring '20s. America had just come out victorious from World War I, and the mood was pure euphoria. People truly believed endless prosperity was here to stay. Industries were booming. Think Ford and the Model T revolution. New inventions like the radio and the refrigerator were transforming daily life. And all that excitement poured into one place, the New York Stock Exchange, Wall Street. Picture a market where everyone was convinced prices could only go up. Buying stocks felt like the fastest, easiest way to get rich. It wasn't just wealthy bankers anymore. Regular people jumped in. Factory workers, secretaries, small shop owners, everyone wanted a piece of the pie. People started investing their life savings, and many even borrowed money to buy even more stocks. This practice is called buying on margin. You borrow from banks or brokers, using the stocks themselves as collateral. As long as the market kept rising, everything was fine. You paid back the loan and kept the profit. But what if the market fell? Well, nobody wanted to think about that. It was a colossal speculative bubble. Fueled by pure greed, the illusion that the party would never end, stock prices had completely detached from the real value of the companies. They were just numbers on a board going up because everyone believed they would keep going up. But every bubble eventually burst. The first cracks appeared in September 1929. Some smarter or luckier investors saw prices at insane levels and started selling to lock in profits. Then came Thursday, October 24th, Black Thursday. Prices started plummeted. Panic selling began. Thousands rushed to dump their shares. The more people sold, the faster prices crashed. A devastating domino effect. The biggest bankers on Wall Street tried to stop the bleeding buying huge blocks of stocks to restore confidence. And for a moment, it seemed to work. Friday and the following Monday were relatively calm. But it was just the calm before the storm. The final blow came on Tuesday, October 29th, 1929, Black Tuesday. That day, panic was total and unstoppable. A record 16 million shares were traded, and the market lost billions of dollars in just hours. People who had bought on margin were wiped out. Not only did they lose their entire investment, but they still owed the borrowed money. Their dreams of wealth turned into nightmares of debt overnight, in a matter of days. The stock market erased wealth equivalent to hundreds of billions in today's dollars, wiping out lifetimes of savings in minutes. So what were the fatal mistakes that caused this disaster? Excessive speculation and greed. People stopped investing based on company fundamentals and started gambling on the greater fool theory. Buy today because someone else will pay more tomorrow. Insane credit availability. Banks were lending money to anyone with a pulse to fuel the frenzy. When the crash came, borrowers defaulted and the banks themselves collapsed, triggering massive bank runs. Zero regulation. The stock market back then was the Wild West. No transparency requirements, no strong oversight. Nothing like today's sector to protect investors or maintain stability. The Wall Street's collapse wasn't just a financial event. It was the spark that ignited the Great Depression, a decade of poverty, mass unemployment, and suffering worldwide. Factories shut down, people lost jobs and homes. Shantytowns called Hoovervilles popped up everywhere. The crisis spread globally because economies were already interconnected. American banks called in European loans, dragging Germany, Austria, and others down with them. So, what can we learn today to never repeat this disaster? Lesson 1. Diversification. Never put all your eggs in one basket. A smart portfolio spreads risk across stocks, bonds, real estate, commodities, etc. Lesson 2. Invest for the long term. Don't speculate short term. As Warren Buffett says, our favorite holding period is forever. Lesson 3. Never invest money you can afford to lose, and be extremely careful with leverage. Borrowed money. It magnifies gains, but also destroys you on the way down. Lesson 4. Beware of collective euphoria. When everyone around you is saying it's easy money. When people with zero experience brag about insane gains in stocks or crypto, that's the moment to be cautious, not greedy. Again, Buffett, be fearful when others are greedy, and greedy when others are fearful. The 1929 crash taught us that markets can't rise forever, and that human psychology, the endless cycle of greed and fear, drives everything. Today we have circuit breakers, strong regulators, deposit insurance, and much more, but human nature hasn't changed. The temptation to get rich quick will always be there. The story of 1929 isn't just a history lesson. It's a powerful warning. Knowledge, patience, and a solid long-term strategy are still our best defense against market madness. I hope this journey back in time was useful to you. If you enjoyed the video, smash that like button, subscribe, and hit the bell so you don't miss the next ones. Drop a comment below. What did you think? Any other financial history topics you want me to cover? Thanks for watching, and I'll see you in the next one.